Welcome to the Zions Bank Economic Update. I'm Deb Speed, and joining me is Robert Spendlove to discuss the jobs report for November and its potential impact on the Fed's interest rate decision. So, Robert, how did the employment situation look last month?
Thanks, Deb. Last month, the employment report came in really strong. The expectation was for something around 180 to 200,000 jobs, and it came in at 211,000 jobs. When you compare that to the month before, we were at about 298,000. So it's not quite as high as it was the month before, but it was higher than the expectation. And it's also higher than the long-term trend. The trend over 2015 has been about 150,000 jobs a month. In addition to the top line jobs number, the unemployment rate once again came in at 5%, which is also a really strong number. The rate that we generally define as natural or zero unemployment is right around 5% for the national level. So that was a good one. And then also average hourly earnings saw strong increases, about 2.3% over the last year. So what we're seeing is a good job market, nice unemployment, and good growth in wages.
So what about specific industries? Was there anything that stood out with great growth or maybe loss that was important?
Mm-hmm. Our strongest growing industry was the trade, transportation, and utilities industry. That grew by 49,000 jobs in the last month. It was the highest growing sector in the economy. The next one was construction, which grew at 46,000 jobs. It's up over 259,000 jobs in the last year. So we're seeing very robust growth in the construction industry, and that's occurring really throughout the country. Our really struggling industries, one was the information sector. It's more of a recent trend. It lost 12,000 jobs in November. However, over the last year, it's about flat, so it's little changed. But the one that we see really kind of losing jobs is the mining, oil, gas, and mining sector, which lost 11,000 jobs in November. But on top of other recent jobs, they've lost about 123,000 jobs over the last year.
So does that have to do with the drop in oil prices that we've been seeing recently?
It is. In fact, oil prices just about a year ago, June of last year, oil prices were about $108 a barrel. This week, they're down to $36 a barrel. So we've seen a dramatic drop in oil prices. And not only have we seen a big drop, but the reason they dropped is really concerning to a lot of people. Generally, when oil prices drop, they'll drop because of a change in demand. So people will have less money in their pocket. They'll have less ability to buy gas, and so the price of oil will drop. This time, the change happened because of a change in supply. So specifically, OPEC and Saudi Arabia specifically have been trying to flood the market with oil to force prices down, and their goal is if they can get prices low enough that they'll be able to push smaller competitors out of the market. So that's very concerning. And just recently, OPEC met and affirmed that they will continue to keep oil prices down in very low levels.
So given these indicators that we're seeing, what do you think that means for the Fed's meeting that they're having?
Yeah, the Fed will be meeting on December 16th, and they're looking at all these indicators. Chairman Yellen recently testified before Congress and said that if employment came in above 100,000 for the month of November, that they would have enough justification to increase interest rates. So there's a very strong probability, I'm virtually sure that they will be raising interest rates at the meeting, and they have a strong indication to do so.
And if we do see a rise in interest rates, is it going to be something that spikes up pretty quickly, or is it going to be more gradual?
The Fed is committed that they want to do this the right way. We've been at 0% interest rates for many years, and 0% for the federal funds rate is generally defined as an emergency rate. So we've got to get out of this situation. They did it specifically to address the Great Recession of 2009, but we've got to get back into a normal period. And so the Fed is going to be slowly over the next few years raising interest rates. The one in December will probably just be about 25 basis points on the federal funds rate. And then over the next few years, 2016, 17, and 18, they'll raise rates by, most people are forecasting around 2 to 3%.
Great. Thank you so much for the information.
Glad to be here.
Thank you for joining us for this economic update. For more economic data and analysis, please visit zionsbank.com/economy.